Hey everybody, welcome to another free edition of our Trader User Group's weekly roundup. This is for the trading week ending October 18th, 2019. Everybody, I'm Preston Brent. Thanks for tuning in. This past week's theme, I think, is probably best put as when takeoffs don't equal landings, then bad things can happen. As a former pilot, I know that for sure. Looking at the indexes first, we saw that in the U.S. markets, the only index that finished in the red for the week, and just barely, was the Dow. It was doing nicely until Friday. More on that later. The S&P was up about 54 basis points, and the Nasdaq about 40 basis points. The Russell was up over 1.56%. So the Russell had a really good week compared to everybody else. And volatility fell again. So we've had a couple of back-to-back weeks where volatility has come in a little bit. It finished last week at 15.58. This week it finished at 14.25. So we saw the VIX come down about 8.53%. And looking at the world markets, it was kind of a mixed bag. I mean, we saw the FTSE down 1.33%. That's the London index. The CAC 40 was down about 52 basis points, or a half a percent. The DAX was up just slightly less than 1%. The Nikkei was up a whopping 3.18%. They were on holiday, so they were playing kind of catch up. China was down just under 1%, 1.2% roughly. And the Hang Seng over in Hong Kong was actually up 1.56%, probably because they've just been penalized so much lately. And then kind of circling back to the US, the best performing sector this week was the communication sector. Healthcare was also really good. Communication, though, coming in first, around 2.1%. Worst performing sector was technology. We saw money come out of the FANG stocks and technology this past week at about 73 basis points, finished underwater. Now, the 12-month trailing PE ratio right now is around 22.7. As for the past 12 months. The forward PE guidance right now is estimated to be around 18.15. So it's lower by about 20%. So it's kind of a rolling 12-month number, the prior 12 to the forward 12. And so it's been reduced about 20.28%. The annual dividend yield is in the S&P, it's about 1.93%. We've seen the 10-year come up off the near the all-time lows, but it's come up to about 1.74%. And depending on who you talk to, people think it's going to go lower, and others think it's going to go up towards 2% as we go through the end of the year. So more on that in a minute as well. So as I lead off this weekly roundup, I saw this morning, it's Saturday right now, I saw earlier today they had the Brexit vote this weekend in Parliament, and they voted to extend the Brexit. They didn't give Boris Johnson the win that he was looking for. Remember, he had negotiated with the EU and came to an agreement, and he was just looking for some votes in Parliament, and he was short about 20 votes or so. So now he came out and said, well, I'm not. He's still pushing for a hard exit. And of course, and he's saying the law is on his side, and of course his opposition is saying the law is on their side, that you've got to delay it now. So again, this ongoing saga continues with the UK. I suspect what may happen is he may be forced to hold a completely new election and re-vote. So I guess, from the liberal standpoint, if you don't like the outcome, just force another vote and keep forcing it until it happens. Bulldog Johnson is more of the attitude of, we're going to follow the will of the people, even though it was a close vote. We're going to force a hard exit. So there's still going to be some choppiness, and we're going to see how this thing plays out. But it's got to be really quick because it's appropriately scheduled for Halloween, the end of this month, and that's only a few weeks away. So we should get an idea over the early part of this coming trading week, this new trading week, what the hell is going to happen, whether it's going to be delayed another 90 days or they're going to hold another vote and vote on it before the end of the year in Q4 and then get a final resolution on just, how this thing is going to play out. It also, this week, as I said, the only index that was in the red for the week was the Dow. And, that was kind of the week's theme of when takeoffs don't equal landings, bad things happen. And we're getting that with the Boeing. I mean, Boeing really, they found an internal email that was really not favorable to Boeing. So the market crashed, or the Boeing crashed, came down pretty hard. And since there's such a big weighting in the Dow, it put pressure on them. And then, not to be outdone, Johnson and Johnson came out and IBM came out. And they both kind of had a really bad week, so that pushed pressure on the Dow to finish in the red for the week, down about 17 basis points. Okay, we did have stronger earnings, Q3 earnings to kick it off, though, regardless of what we got from Boeing and Johnson and IBM. I mean, we had strong banks and healthcare also coming in fairly strong, with the exception of Johnson and Johnson. So that's kind of like a every good piece of market data being met by an equal piece of stale pie. So it kind of just put the markets on a neutral kind of standing. Now, we also had slower GDP numbers come out of China this week. We had the issues over Turkey and Syria. So all of these things are just kind of keeping the market in check right now. In addition, we've got coming up that we've got the Fed fund futures was pricing in about an 89% probability of another 25 basis point rate cut. So most analysts believe they're going to cut it one more time October 30th when they meet the end of this month, and then they're going to just stand pat and see how it goes. So this is already priced into the market. In addition, the Feds have been buying about 60 billion of short-term T-bills. What's that done effectively is drive higher the front end of the yield curve, the interest rates, because the interest rates go up, rather they go down when the Feds through the Treasury are buying the T-bills. Okay, that tends to widen the yield curve. So let's move the yield curve into positive territory, primarily the 3s over 10, which is the 90-day interest rate versus the 10-year Treasury note. That's widened, so that's been a good thing, because it's been negative since about May of this year. Now the 2s over 10, which is the 2-year over the 10-year, it's been pretty much positive. It's been flat, but it's been positive short of 1 day or so of a inversion a month or so ago. But outside of that, it's been positive too. So this has helped out with the 60 billion of monthly purchases. Now, this process, they don't call it quantitative tightening. They don't want you, or quantitative easing. They don't want you to even say the word quantitative easing with this 60 billion, but the net effect is what it's doing. Remember, over the past 3 or 4 years, they finished their quantitative tightening in November, I believe, of 2017. But that took roughly about 600 billion off the markets. So that just kind of soaks up the dollars that are floating around globally. So there was a hunt for dollars and liquidity. So the Feds came back out and said, okay, we got to put some money back in. Okay. Now keep in mind, quantitative tightening has the same effect as raising interest rates. So while they were raising interest rates over the past 5 years at 25 basis point clips, they also were doing quantitative tightening. So the markets and the economy really wasn't quite ready for that. So they've kind of reversed that course and made it a little bit easier. Now remember, I was telling our members, for those of you that are members on our site, I was telling you guys, even on this Brexit stuff, we've got to go short the dollar, long the euro, long the pound, because it's going to be very good with the Brexit. And then over the weekend, I said, leading up to the weekend, you could take profits if you want, because flip a coin on how the vote would go in Parliament. Well, we just saw the vote. It's probably going to add more confusion for the next week or so, but we should get some clarity here this next week. All of this stuff with a weaker dollar is going to help gold and silver appreciation. You guys know, especially you members know, we're playing the silver side because the gold to silver ratio is really elevated. So there's a better play in silver versus gold, but I certainly wouldn't mind advocating holding gold as well. Okay. Keep in mind, with a weaker dollar, about 45% of the S&P earnings come in from offshore. So a weaker dollar is certainly going to flow to the bottom line of these companies. So that's a good thing as well. Okay. Now, looking at the screen here, you see I've got I got an Ichimoku chart on the screen. You can see here the support and resistance points. This is what we would call a very wide S1 zone. Okay, and it runs from around 2,900, call it, to about 2,900, right in that area there. So, and you can see the support zone has been fairly stable down in this area here, no more than down around this level here. And granted, we've had these offshoots where we've gone lower, but that's been a fairly solid support zone. And I've been telling our members, you can see here, we've just been in this really tight range like this. It's almost like a bull flag after we bounced off this hair and we moved up here like this. The typical breakout is to the upside. Okay. And I've said we've needed a catalyst to get us up, make new all-time highs at the 3029.50. This is the E-mini S&P 500 futures, by the way. So we need a catalyst to get us up. And we've got a number of catalysts that are floating around out there. We started off, even though the bar is very low for the Q3 earnings, okay? Even though it's very low, we're beaten. So it doesn't matter how low the bar goes, that's not what we pay attention to. We pay attention to the beats and forward guidance. And right now, that's coming in better than the lower bar and the lower expectations. So that tends to put a little bit of an upside push in the markets, okay? But it's not enough of a catalyst, okay? Because we're getting still some negative stuff, as I've showed you along with Boeing and IBM and Johnson & Johnson and just some of the other things slowing global economy, 14 trillion in negative interest rates. So, and for our members, you guys know there are some great plays for us that I see now, the ones that we've been doing, as well as some new ones are going to be cropping up here as we go through Q4. So for our members, I'll be talking to you about this Sunday evening in our weekly market watch. And if you're not a member, I highly encourage you to come in and check us out, because we got a great international group of folks in our user group, and it's a great way to build your mastermind and your connections and contacts as far as just what's going on in the markets and where everybody's and how we're playing it. And of course, you can follow along with my live trades because I'm doing real money. So I'm not just doing a trade recommendation and just putting it on paper. I'm trading real money. So you can follow along with me as well, but you need to be a member to do that. So you can see on this Ichimoku, we need a catalyst to climb back up in this direction right here. And there's several that are out there. Q3 earnings, the Feds, if the Feds do what they need to do, 3 weeks, we get Trump meeting Xi. Supposedly, if they can work out this phase one deal, no matter, again, it's expectation, folks. Don't look at the content of phase one. Just look to see, are we making progress? Are we just treading water, or are we moving forward? If we are moving forward, no matter how slow, the market's going to interpret that as a good thing. Okay, so we've got enough catalysts to get back up here, but we're going to need help. We're going to need Q3 earnings to come in above expectations. We're probably going to need that 25 basis point Fed rate cut. Doesn't matter whether it's required or not, or needed or not. You can talk to a half a dozen analysts that say they shouldn't do it. I can show you another half a dozen analysts that say they should do it. And we're not here to play they should do this or they should do that. We're here to play the direction of price. Okay. At the end of the day, for us, we're not trying to play the political game. We're just playing the price game, price, volume. Where is everything going? And that's how we get our paycheck. So this is kind of what I'm seeing right here in this Ichimoku chart. Now, if I were to just take everything off the screen here, clear it up, let's just erase the drawings, and then let's just zoom out. Let's say all the sun and the moon and the stars line up and it does move and we do clear that area. Then the next question is, we're in dry powder. Where do we go from there? Okay. Well, once we hit dry powder, then we're going to look for extensions, common extensions. And the first common extension, surprisingly, is almost right at 3,100. That's going to be our next target. Now, I've told our members, if these things line up, we will hit 3,100 more than likely, call it 3,150, which surprisingly is at the 38% Fibonacci extension off these all-time highs right here. Okay, so these are the next bona fides. Now, once we get up there, we'll see a lot of money that's gone into debt from equity get sucked back out of debt and go into equity, and it'll create kind of a FOMO approach, the fear of missing out. And this is the fear and greed, which we love to trade in our user group, right? We trade fear and greed. I've always said that the markets can be very unpredictable. Price action can be very unpredictable. No one's been able to figure that out. But what we can do, and what we do figure out, and we join what I call the red stripe zebra approach, which is part of our philosophy, is the only predictable nature of the markets is the predictability of human fear and greed, how it reacts to the unpredictability of the market. So now if you understood what I just said, then you get it, okay? And that's where we're playing. So this is the upside potential up in this area right here, should those things line up. Now, if they don't line up, then, and let's say depending on where they come in, we could pass these levels down here like this and come back down and quickly test these lower levels down here around the 2800. Okay. I believe, and again, at the end of the day, it doesn't really matter what the hell I believe, but it looks like things are lining up where they want to go up in this direction, at least over Q4. Okay. So we'll see, and we'll play price action no matter what I believe. We're going to play the price action and whatever it gives us. But this is a little bit about what I'm looking at right now using this Ichimoku. Okay. Now, if I switch over and let's just take another look at the chart, and what we're going to do is we're going to look at a Bollinger Band chart. And let me just flip the screen here. Let me just see here. Okay, let's come over here like this. Let's come over to the Bollinger Bands. Now, I use a 3 standard dev in the Bollinger Bands rather than the 2 that you typically get. And let me just put it on a daily chart here. So now we're looking at a 3 standard dev of the Bollinger Band. You can see again, same chart action, but the indicator is using 3 standard dev, of which the red line is 3, the purple is 2, which is the standard Bollinger Band, and the blue is a 1 standard dev. The yellow is the center. Okay, we're kind of just being supported on the center right here. You can see the Elliott wave count would suggest a little bit of a pullback and then a move higher. Okay, generally in an uptrend, we're running towards a running to, like a carrot running, like a horse running to a carrot in front of them, the purple line, which is the 2 standard dev. So in a nice momentum move, I like to see us kissing or running up towards that level. We're flat right now. We need to get that catalyst moving. Okay, and you can see a fib node pullback of 236. Okay, so 2861, which is down in this area down here. So I wanted, it looks like the markets want to move higher, but we got to have these things line up as I suggested before. Okay. So that's a little bit about using the Bollinger Bands, and you can see the expansion and contraction, as we get into these, and these expansion contractions is how we've played, we want to be more bearish and long volatility, or we want to be short volatility, right? And it's just something that you need to get in the habit of looking at, a little bit of a market awareness before you take any individual stock and, rock and roll bullish or rock and roll bearish, right? Okay, so anyway, let me just flip the screen. Let me flip the screen over and let's just take it back to a traditional candlestick without the Bollinger Bands in here. This is a weekly chart. You can see how the MACD has been getting lower and lower. So the traditional bearish divergence that we use was at that trigger right there. Okay, right at the trigger at the beginning of August, because we had the traditional bearish divergence from that high to that high, and to this high cross here to this next lower cross here. Granted, we had another lower cross here, but it was not a traditional bed. What we call it is a poor man's bed. Okay, now you can see us, and again, I'm using a weekly chart here. You can see that we're working off this divergence here from this high point here to this high point here, and then that not quite high point, but a failed attempt there. And you can see where we're just below the 3029.50 high point, all-time high in the E-minis. Okay. Now, if I were to take it and let's put it back on a daily. So let's get it back into the mode that the 50 and the 200 start to come into play here. You can see on the 50 and 200, both the 50 and the 200 have upward vectors, which means the price action wants to go higher. Okay, that's why this looks like a bull flag kind of pattern. Okay, it's not ideal, but it kind of's got that shape and configuration to it. Should we bust a move to the upside, that'll be good news. And all it'll take is the announcement that we're going to have another 25 basis point rate cut would probably do it, and or a tweet from Trump and China confirming that, we're going to agree to this phase 1 deal. We're going to get it signed in 3 weeks, and then it's on to bigger and better things kind of thing. Okay, no matter how small and how slight, as long as we're not treading water, then that's a good thing. You can see this long yellow line here, which is volume over price, which shows most of the volume and the equal nature of the bull and the bear buying versus selling took place right around 29.85. Okay, and there's another volume area right here and these volume areas defined as going back 150 days. So you can see here on this one, it's down around 29.30. So we got support underneath the price action here. So neutral to slightly bullish is kind of the way that I'm going to appeal, unless we come down and we break the 50. It does not hold and we come lower. Call it the 29.50 area. If we go below that, then we'll shift our stance a little bit. But right now, I'm still neutral to bullish in the pattern here. Okay. Also, if we come in and we look at, let me just put this out here on you, the volatility, and let's just look at the common nature of volatility, which is the VIX. You can see we're still in the green. We try to get up in the yellow zone, but we're in the green zone. So obviously for those of you option players out there where we have many, let me just zoom it out a little bit. You can see in this area here, in the green zone, we do different kinds of strategies. We adjust some of our short vol strategies when we're in the green, because when we're in the green, we also know we can quickly move into the red or the deeper red or into a black swan, right? Because the risk of a downside move in vol is relatively low or much lower than an upside move. So we've got to accommodate that when we're in the option world. Okay, now we go through that a lot in our option masters. There's a lot of education on trading volatility or trading any asset under different volatility conditions. And, I generally label them, to keep it simple for everybody, 5 zones in volatility. And you can see zone 5 is considered a black swan where the VIX is greater than 50. If I put it on the weekly chart, we've only had, based on my definition, one time going back, and this was back in we had it hit right here in February 2018. That's when XIV went out of business, and there were just too many on one side of the trade, meaning that every hedge fund and their uncle was shorting volatility. And when volatility spiked, then all these people had to, these hedge funds, everybody else had to unwind their shorts, which means they had to buy, and vol spiked here. The last time we had a black swan kind of event, meaning the VIX went over 50, was back in 2015 in August, when China surprised everybody and devalued the yuan over 10% over the weekend. That shocked the markets. So generally these spikes up in this area here, if you can catch it, are really great times for certain kinds of option strategies. Otherwise, if you don't know how to trade it, you got to be very careful, okay? Because most of those black swan type events take money out of everybody's account, in many respects drives them to zero. Okay, so that's a little bit about what I'm looking at there. And then if we look at the front month vol skew, you can see it's in the green here. So let me just come back to the daily. So we're in the green on the fall, which means we're in contango. Okay, so that means there's not that kind of fear out in the marketplace. And we look at the back month vol skew, you can see November, December, we're in more of a contango environment. So there's not fear out there right now. Okay, so that's something you need to understand. I instruct all of our members in our user group that when we're having a down day, or the markets are, the E-minis, the S&P is down more than 10 points, 15 points, like that. It's not an ugly day. It's down, but it's just not too ugly. Look at the VIX and look at volatility and look at the skew, the term structure, comparing the VIX to the front month vol futures, and then the front month vol futures and the back month vol futures. Look at the difference between the two. And you can see if it's in contango or in backwardation. When it moves in backwardation, then you need to be a little bit more fearful. Okay, so there's nothing there that I see that is of consequence. If we look at treasuries, okay, and look at bond market, you can see up in this level up here, I was suggesting that we go out over a year and a half or so and pick up TLT puts. I think interest rates are kind of finding a bottom. So I gave you guys a freebie here for the free weekly roundup, and it turned out to be a nice little trade, right? I mean, when this comes down, TLT comes down. If we look at TLT, it kind of follows the pattern of the bond market. Okay. Now, a lot of people think that TLT is going to go back higher, meaning the bonds are going to go up and interest rates are going to come back down again. But again, as I said, an equal number feel just the other way. And no one's been able to predict this. Okay, I mean, nobody has. I haven't seen anybody that has been consistent. You'll have people that'll pick the right direction, but then ask them how many other picks have they gotten right in the interest rate market, and you'll see they're batting just about 50-50. The best way to do this is play price action and volume, because if you try and do it any other way, and breaking key levels both to the upside and the downside, if you try and do this any other way, it's not going to work, guys. It's just not going to work. So this is what I'm looking at. And if we look at the interest rates, right? If we look at the 10-year rate, it's closed out the week at 1747. All right, we're off the lows here. In fact, I've got to update this thing here. But we're off the lows, right, like this. The 2019 lows at 14249. All right, near our all-time lows. And you can see here, this is not a divergence to the upside. It's a poor man's bullish divergence, what we call a poor man bud. And until we can break out over that 190 and clear it, then and the heavy volume and where the bulls and the bears equaled each other was right at 2.04. I think it will eventually work its way back up there. Okay. Now, if we don't have the sun and the moon and the stars line up, then we're going to have some difficulty in this with some of these things I talked about earlier in the opening statement here for this weekly roundup. But I do believe chart wise, it indicates that that's kind of where we're going. Okay. And of course, if we come over and we look at the British pound, you can see here, look at this. The thing I love about currencies is they trend. When this thing started coming down, we were all over it. At least I was all over it, suggesting to our members there are a number of different ways to trade the British pound to the downside, right? Probably the purest way is just do pound futures. Just trade it down. Use the regression channel to pick your buy and sell points, profit taking points, but you can see how long it stayed in it. I mean, we officially started on March, but you probably wouldn't have been able to pick it up right around April or May timeframe, right? Down in this level down here, what happens is a lot of people tried to buy the bottom here and it came back up, and then there were more sellers willing to come in and sell it off. So you could have picked this point right here to sell it and you would have been fine, which is what we did and what I was recommending. And then you can see we came all the way down and we made some lows here for 2019. Now, once we broached the top, we came up, we had a little bit of an attempt, and then we had this rally with the Brexit, and they just kind of undone everything. So this was a rally in hopes that, when Bulldog Johnson got his deal with the EU, they were going to vote this weekend. But now you may have some profit taking in this, and there's going to be some choppiness and unknown nature until then. But what I was suggesting to all our members is either along the British pound, but a better play would have been to short the dollar. All right, now if we look at the US dollar, it's really a US dollar index. Okay, so if we look at the dollar index, you can see here on this channel, and let me just get this off so it kind of settles it out a little bit here. You can see on this dollar index, again, it's a wide range, but we've been sellers of the dollar index, or UUP if you don't have the dollar index futures. UUP, pick up puts right in this area here. Down in this area down here, you want to buy calls. So I was suggesting buying puts up in this area of UUP, and members were taking it and making some money. And then we climbed back up again. There was another entry point up here. This one was even better. All right, we came up almost near our 2019 highs because we made 2019 highs in the dollar back in early September. Now we're back down towards the bottom down here. Okay, so this would be an area where we got to have a resumption of the trend, but again, it's going to depend on what happens with Brexit. Okay, I think there's going to be some profit taking in that. There's going to be profit taking in this, which will kind of reverse both of them. This going up, the pound coming down. But let's watch and see how this goes. But selling the dollar was our trade. It turned out to be a good one, or going long the euro. Because I pointed out to our members going along the euro, here is the regression channel, right? We were down in this level down here. We were outside the red boundary, which suggested go long the euro to resume the downward trend, okay? We're now back up above the midpoint here. We captured the 50 EMA, the 200 EMA. They're both pointing down. They both have a downward vector, both the 50 and the 200, which is the yellow line. The 50 is the red line. But this would suggest taking some profits right now, and let's just see how this thing winds itself out with the Brexit, because that affects it. Keep in mind the euro is almost 58% of the dollar index. because it's really not a dollar currency, it's more a dollar index, which is based on the movement of other currencies. And the euro mounts 58% of it. So wherever the euro goes, it's like a 90% chance the dollar is going to go in the other direction. All right, so you can play the dollar short or UUP short with puts, or you can play the euro long futures, or FXE, Foxtrot X-ray Echo, for the euro playing it long side. And the pound is about 12% of the dollar. So when you have 12% of the dollar index and 58% of the dollar index going up, then the dollar is going down. I don't care what they're doing. The Fed can be hiking rates like crazy, but the dollar index is going to go down. And the yen, let's not forget the yen, it accounts for almost 14% of the dollar index. And of course, the yen, it went up as well. All right. So here's the yen over this. But keep in mind, the yen goes like the US bond market. The yen is kind of a global flight to quality kind of thing. So when global growth is slowing down, money goes into the yen. Now, you can look at this chart here and say this could be a good news kind of thing for coming into Q4, because you could probably say, well, gee, that looks like a Head and Shoulders. Not really, but it's almost like it's giving you the bird. This would be like the rat brain signal of the day, But if it breaks to the downside, then the measuring objective would be the distance from there to up in this area here, which would put us down in this area here. And it would do that if we've got great global growth. In other words, Trump and Xi come to a term, an accord, as the pirates used to say. They come to an accord, they sign phase one, and then they walk out of that meeting with commitments to move on to phase two, whatever that may be. Probably IP rights and other things. We've got strong Q3 earnings. The Fed's cut rates by 25 basis points. They've got some clarity around Brexit. You're going to see global growth kind of bottom and move higher. You're going to see interest rates move higher. You'll see the yen come down. Some of these risk off trades like utilities and others will probably pull back just a little bit. And you'll see some cyclicals and growth stocks pick it back up again near term. So there's a lot of things that can move this market. And we're going to be following all of this to kind of pick the best selection coming into Q4 of this year. So these are just some of the things that we're going to be watching. Now, if we come into the metals, I talked about gold and silver. Here's gold right here. You can see on this chart, we're kind of following this regression channel down. If I were to mark the high point right here and just kind of where we're sitting right now, there's a regression channel kind of moving down. Unless we break this blue line to the upside, the upper boundary of it, I'm not playing gold at this point. Our breakout trade was back down here at 1372. Okay. Turned out to be a great trade. Remember, it's $100 a point in the futures market, so you could have done very well in the breakout trade that I had here for us in our group. And you can see the 50 EMA is now slowly starting to turn down. The 200 EMA is still pointing up. So longer term, I'm still bullish gold, but shorter term, I think it's just some profit taking is what's going on right now. Same thing with silver. If we look at silver, as you guys know, we got long silver down here. I was getting our members long silver. Huge profits up here. It's $5,000 a point. It's like owning 5,000 shares of SLV. Is the equivalent of one silver futures contract. Okay. Again, I can connect the high point right here and where we are right now, and that gives you the regression channel. We're just like gold, we're kind of right in the center of this regression channel, so it's a profit-taking mode. You can see here the 50 EMA still has an upward vector, so does the 200 EMA. You can see all these yellow bars here, which shows that silver tends to move up and consolidate, move up and consolidate, move up and consolidate. It also does the same thing when it comes down. Just moves down a little bit faster. But there's going to be profit taken in here. Longer term, I like silver as well. Remember, a weaker dollar is going to make it also put a little bit of wind in the sails of both precious metals. Okay. Now, one thing that I've been following here very closely is palladium. Palladium has moved up to new all-time highs right up in this area here around the 1742. We took some trades in palladium, as you guys know, back over here. We made some great money. We had members making 30 grand a contract. One of them traded a couple of contracts, but it was just a very quick move. Palladium is $100 a point, but because they do not allow options in palladium, it's not that they don't allow them, they just don't they don't have them. So what that means is money that's long and or short can't hedge in the options market. So they've got to get out really fast when it's going against them because it's $100 a point. And you generally have a lot of sovereigns playing in this world. And the only place generally you get palladium right now is Russia and Africa primarily. But I do believe that palladium is going to start reaching a point here where being on the short side is going to make sense. And it can move from the 1726 to 1600 really quickly. Okay. And if I were to kind of, let's say, just kind of zone it in right here, it would look something like this. So you can see that support resistance zone right in here. So it's a wide zone, but call it 1575 down to around 1550. Okay. And we're at 1725. So that's 200 points. That's $20,000 per contract on this move here. I'm just looking for a trigger to want to jump into this. And for our members, I'll call it out for you. If you're not a member, I highly encourage you to come in because these are great trades. Market dislocations in the commodity market are some of the best trades you can do. Okay. And they're quick. So that's a little bit about what I'm seeing in the metals market, precious metals. Copper is going to go where China goes. Okay. When copper kind of falls, so does China. If we look at copper, you can see here, it's just been in a steady downward move. We haven't been able to make new highs because China is faltering. Once we do, then we'll be able to break out. I think once we get the China deal, once we get it off the table, or as best we're going to get it, you're going to see copper come back up, and that would be a good one to play. Copper or Freeport McMoran, which kind of chases copper. You can see down in this area here, it's cheap. You could buy the stock, right, and just sit on the stock and just wait for China to come around. Okay, and the downside, the risk of a bigger move is more upside risk than downside risk. Okay, so that's how we would look at that. In the oil market, we're still sitting around my level, which is around 55. You can see the value zone is 56.40. It chops above and south of that value zone. I've got a support here in the low 50s. So, from an option strategy standpoint, trading flies or condors, hedging the bigger move, which generally right now in oil is more to the downside. We traded this dislocation here when the biggest refinery in Saudi Arabia got hit by some cruise missiles. We faded this move here because I just did not see this thing carrying much further. And remember, Saudis are trying to get their IPO going with Aramco, and for them, it was a matter of national pride to get that refinery going real quick. So they just stopped everything and put all their efforts into doing it. And the minute they came out on the news and said it's not going to last very long, the oil production cut, then off we went. So that was a high prob market dislocation type of commodity trade. Okay. I mean, it literally, if you'd have held it, it moved from the low 60s all the way down to the low 50s. So you're looking at $10,000 per contract. Most of our group, I said, if you close the gap, and the gap was way down in this area down here around 55. So it's about a $7 move. If you close the gap, then get out. So, taking a $7,000 profit versus holding it till the end of another $3,000. I mean, I wouldn't have faulted you at all because you were just fading the gap. And that was a good trade also. And then, of course, we got ag. There's things shaping up there. Same thing in the meat market with some of the bullish run, some of the softs that we've got too. So these are just some of the things we got floating around, guys. Members, I will see you this Sunday evening. If you're not a member, again, I encourage you to come on in and join us. We got folks joining us all the time. Love to have you in our room. All right, everybody, have a great weekend. And members, I will see you tomorrow night for our weekly market watch. Take care, folks. Ciao.